Welcome to Investing from Scratch in 2026, the complete strategy. If you're new to investing and want a clear, step-by-step guide to building wealth, you are in the right place. By the end of this video, you will have a complete roadmap to start your investment journey with confidence. We are going to cover everything from getting your finances in order to choosing the right investments and avoiding common pitfalls. Let's get started. Before we talk about stocks or funds, let's discuss the most important tool you have, your mindset. Investing in 2026 isn't about getting rich quickly. It is about playing the long game. The market will have its ups and downs, which is completely normal. Successful investing requires patience, discipline, and a focus on your long-term goals, not on daily market noise. Think of yourself not as a market timer, but as a business owner. You are buying a small piece of successful companies and holding them for growth over many years. This perspective will help you stay calm during market volatility and remain focused on your financial future. Now, let's talk about financial preparation. Before you invest a single dollar, there are two critical steps you must take. First, create an emergency fund. This is 3 to 6 months worth of essential living expenses saved in a high-yield savings account. This money is your safety net. If you have an unexpected expense, like a car repair or a medical bill, you can use this fund instead of being forced to sell your investments at a bad time. Second, you must pay off high-interest debt. I'm talking about credit card debt or personal loans with interest rates of 10% or more. The guaranteed return you get from paying off this debt is almost always higher than what you can reliably earn in the stock market. Investing while carrying high-interest debt is like trying to run up a down escalator. Get your financial foundation solid first, and then you can start building wealth. A common question I receive is, how much money do I need to start investing? The answer might surprise you. You do not need a lot. Thanks to modern brokerage platforms, you can start with as little as $50 or $100. The key is not the amount you start with, but the habit of consistency. Investing a small, regular amount is far more powerful than waiting until you have a large lump sum. This strategy is called dollar cost averaging. By investing a fixed amount regularly, say $100 every month, you buy more shares when prices are low and fewer when they are high. Over time, this smooths out your purchase price and reduces the risk of investing all your money at a market peak. So forget the myth that you need to be wealthy to invest. Start with what you can afford and focus on being consistent. So, where should a beginner invest? For most people starting out, the best options are exchange-traded funds, or ETFs, and index funds. Let's break down what these are. An index fund is a type of mutual fund that aims to track a specific market index, like the S&P 500, which represents the 500 largest companies in the United States. When you buy a share of an S&P 500 index fund, you are instantly buying a tiny piece of all 500 of those companies. This provides instant diversification. Diversification is the single most important principle for managing risk. It means not putting all your eggs in one basket. An ETF is similar, but it trades on the stock exchange just like a regular stock, meaning its price can change throughout the day. Many ETFs are also index funds. For a beginner, a low-cost, broad market index fund or ETF is an excellent starting point. It offers diversification, low fees, and has historically provided solid long-term returns. You avoid the difficult and risky task of trying to pick individual winning stocks. Once you have chosen your investments, the next step is to embrace a long-term strategy. The most powerful force in investing is compound interest, which is when your earnings start generating their own earnings. But this magic only works over long periods. Your strategy should be simple: buy and hold. This means you continue to regularly invest in your chosen funds and resist the urge to sell when the market gets shaky. Set up automatic investments from your bank account to your brokerage account each month. This set-it-and-forget-it approach automates your wealth-building process and removes emotion from your decisions. Remember, time in the market is more important than timing the market. Trying to predict market movements is a losing game. A consistent, long-term approach has proven to be the most reliable path to financial success for everyday investors. As you begin your journey, it is just as important to know what not to do. Let's cover some common mistakes that beginners make. First, avoid emotional decision-making. Fear and greed are an investor's worst enemies. Seeing your portfolio value drop can be scary, but selling in a panic often locks in losses. Sticking to your plan is crucial. Second, do not chase hot stocks or trends. You might hear stories of people making a fortune on a single stock, but these are rare exceptions. For every success story, there are countless untold stories of losses. Stick to your diversified, long-term strategy. Third, pay close attention to fees. High fees can significantly eat into your returns over time. Always choose low-cost index funds and ETFs. A 1% difference in fees might not sound like much, but over decades, it can cost you tens of thousands of dollars. Avoiding these mistakes will keep you on the right path. To wrap things up, let's review your complete strategy for investing in 2026. First, adopt a long-term mindset focused on patience and discipline. Second, build a solid financial foundation with an emergency fund and by paying off high-interest debt. Third, start investing with an amount you are comfortable with and do it consistently through dollar-cost averaging. Fourth, choose simple, diversified, low-cost investments like broad market ETFs or index funds. Fifth, commit to a long-term buy and hold strategy and automate your investments. Finally, avoid common mistakes like emotional trading, chasing hot stocks, and ignoring fees. Investing is a marathon, not a sprint. By following these steps, you are not just investing your money. You are investing in your future self and building a foundation for long-term financial freedom. You have the knowledge and the plan to get started. The next step is to take action. Thank you for watching. I hope this guide has given you the confidence to begin your investment journey. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more content on personal finance and investing. Let me know in the comments if you have any questions. See you in the next video.